Good morning, everybody. It is June 7th. This is the weekly review for members. It is a very slow, deliberate market right now. I can't get any traction to the upside, yet refuses to go down any significant amount. Last week, we actually saw some outperformance here in the Russell. A lot of times, the Russell can lead, so I guess that's a good thing. At the same time, there was no traction anywhere else. Yearly returns, if you're in the S&P, if you're in the Dow, you've gone nowhere. You certainly have made some gains elsewhere. We're going to talk about that. I'm going to start out here with a quote from a good friend of mine, a trading friend. He says, "When I buy, I feel stupid. When I sell, I also feel stupid." This is Alan Farley. He's a good friend of mine. He lives down in Arizona. I was talking to him the other day. I saw this quote. I had to call him up because I was laughing. It is that way right now. Everything you do seems to be the wrong thing, and that's because it's range trade. If you're trying, so many people get excited about a stock when it starts to move up. I think that's the majority. Right now, moving up is not the right thing, and we've seen that over and over, where if you go buying something that looks good, before you know it, it looks bad, right? Then you sell it. By the time you sell it, it looks good again. So like right now, I don't want to draw it that way, but if we take the broad range that's been in effect here, it's really since about here. This looks like it's going to break out, doesn't quite do it. Here it actually does it, teases you for about a week, and then next thing you know, you're right back down where you started again. So you buy, you feel stupid, and then you sell it down here somewhere and you feel stupid again. It's been that way. That's what a range trade does to you over and over and over. So that's the S&P. What happened last week? Really, the volumes had tailed off here as we come into the summer months. I mean, they've been pretty minor for a long time, but certainly no action in this market. You get the big pull down Memorial Day, the day after. You go sideways basically, right? I mean, this thing traded inside the bar. If you go back and look at it, if you pull this way, right? It was basically inside this bar now for, a good 6 days, 6 bars. Finally, the breakdown bar again on Thursday. You stay under it on Friday. You're back underneath, and we should pull over the weekly to show that. You're back underneath the bullish retest regenerate zone that was created on the breakout. And so you got this breakout, and now it trades back underneath it. Now, as we know, it needs to stay under it, for at least a bar. If it does that, then that says pretty much, from a directional standpoint, that says, okay, it's not this again, it's back down to this. And so, if you stay down here another bar, that pretty much says, okay, the bulls are not in control. And it's not that the bears are in control, but certainly the bulls are not in control. And that changes the direction again. The risk, as we know, is down here. It's on all these swing points. If we go down to these guys and start breaking these, then that puts these all in play, right? And if all these come into play, then that, price point wise, that's around 2040. If we pull the weekly back over and look at it, right, 2040 is back down here. And now you're getting into the intermediate term. If we start seeing breaks on the intermediate term time frame, right, then we can see more damage, and that becomes a little bit more serious. Right now, it's the same thing. It's just a range. We're in the top of the range. We get sold at the tops. We get bought at the bottoms. I expect that's probably going to continue. So technically, fundamentally, what were the major things last week? The S&P, as I just showed, it failed to hold that weekly time frame. Retest regen. If it stays that way for another week, well, we're probably going to trade down into the bottom of the range again. NASDAQ, it's holding up really well. It's still within those all-time highs, that are out there from 2000. Trying to get back to them. If you pull up a quarterly chart on any of your favorite charting packages, that's back at 5132. We're sitting here at 5119 high. Very close. You get that close, they almost always want to try to reach up there and grab it. So the NASDAQ still continues to be the index where the strength is. The NDX itself is doing a bullish retest regen here on the weekly chart. And so that's still a positive as well, right? You break out on this bar, you go up, you come back, you've been testing. This can get, when you're within 6 bars, you can get to the bottom of the bar. I mean, it's unlikely you're just going to barely touch it and move on. So, this to me kind of says, okay, it's positive in that it's doing it and holding it, but it's a negative in that, this could pull back to the 43.90 area. And you're trading up here at 43, well, actually 44. So, this could drop 50, 60 points and still be doing the retest, regenerate. If we move back to the other thoughts here, there's the internals, right? The internals are horrible. They haven't improved. This week, we started to break down in other areas, which is these negatives we'll talk about here in a second. And those breakdowns now are starting to, shall we say, uncover trading signals that are bearish. And we haven't seen bearish trading signals for months. That's because the market, if you think about what the market's doing, right, it had been doing this for so long, and now it's really starting to flatten out. When you flatten out, your swing point lows become exposed and you start to break them, right? And that's when you start to see the internals get worse and worse as this thing flattens out, because new highs aren't being made, new lows are being made, right? Your internals just do not support continued rise in price. And until this market projects higher, that's just going to get worse and worse. There are still some very hot sectors though. And if we look at those sectors, if you're making money in this market domestically, you're in these sectors most likely, because everything else isn't doing anything. Now the SOX is the most visible one, right? Everybody knows about it. The chips make the big run here. That's M&A, merger acquisitions. Now they come back. What are they doing? They're doing a bullish retest regen. They're holding it. And it looks like to me like they're ready to bounce. You got an under-over doji. That looks like it's just about ready to reverse, try to come back up and at least test up into this area. So chip stocks has been one of the bright areas, but there's others like the social media is starting to heat up again, right, in terms of pushing higher. One sector has been extremely hot is hack, right, the cybersecurity firms. Big volume rise here. What was this on? This was on, the government being hacked in terms of in a huge way. And so I'm sure that there's more focus being pressed on these. And if you look inside that group, FireEye, there's a bunch of them, PanW, right, the Palo Alto. All of those continue to find support. There's others outside of that, like broker-dealers are doing really well. And in the financial space, even though the large cap financials are having a hard time, if you look at the regionals, like KBE is one way to look at it. You could also look at the KRE. These stocks have been doing well and continue to do well. So there are kind of stealth markets continuing inside this malaise that's going on. And those hot areas is where the money is if you're playing internally. Another positive last week, even though it's looked upon as negative probably from most folks, is that so far in Europe, the CACs, the DAX, the two big ones, are still holding their ranges. So this range, if you remember, we started talking about the ideal of a range 3 months ago. This range is this whole area, right? Inside of it, you kind of have another range, and you kind of have these two areas. It's down at the bottom. It's testing, right? It's testing on lower volume as it comes into this low. That's the CACs. The DAX looks a little bit weaker, because it's been a weaker index. It actually tested the low now. You had 1.1 there. You test on 887. You're under it. You're back over it. You hold it. That looks like this is going to set up to try to bounce. And if it bounces, they're going to hold their ranges. If they hold their ranges, then we're going to see those markets actually trade back higher, which is going to help the US markets. If you look over to the strength area in Asia, you got the Shanghai and never even printed a swing point high because it won't give it up that long. Next thing you know, it's at a new high. This actually looks like it's going to trade higher again. There is some news came out on Friday. I'm curious to see what that does to this. In other words, is this going to be a false break that actually traps some folks? And that is that they're looking at clamping down with respect to the margin that they're allowing, and also potentially on the short sells. So we'll see how that trades. But right now, that looks pretty positive. And then if you look at the Japan, the topics, the Nikkei is also pressing higher and staying higher. Even though it looks like it wants to set up the range, you've got the yen that's being just decimated again. And as the yen goes down, that of course puts pressure on the equities to go higher. And I'm trying to grab that chart. Here's the FXY. Took a huge drop again on Friday. This thing is in a free fall, and of course that is what's keeping this market at highs. The negatives, we'd have to look at the transports, and I don't put as much as I probably would 20 years ago on the transports. But if you look at the transports, they are doing a bearish retest regen, and so they are trying to regenerate to the downside. I see some folks saying, hey, this broke down and here it is right back up here. Well, all it's doing is retesting. And until it gets over this, the bears are in control, in my opinion. And right now, it's testing back into the resistance zone. As it comes back up here, this is going to be hard to get over. More than likely, this thing is going to regenerate lower, right, after this little bounce is done, wherever it goes to, and project down. Where is that projection? As I've said before, it's down on the tops of these October lows from last year. So this to me still looks negative. It hasn't even got back yet to the retest regen on the weekly. What is that, 154.02, and you're a little shy of that. So this to me still looks negative. I don't see anything positive there. If we look elsewhere, and this is where it really gets more interesting, IYT, XLB, XLP, XLV, XLU are all breaking down. Let me just show you these real quick. And then they broke down on the dailies. Here's the XLB, breaks down, changes trend, trends, transitions, right? If we look at the others, we had a massive breakdown in the XLP. This actually went bearish the last 2 days of the week, breaking multiple swing points. It also broke on the weekly time frame and is about to break again on the actually broke 2 swing points already on the weekly. This isn't saying okay it's a bear market, but this is definitely saying that when you line these swing points up, the possibility and the probabilities increase that you're going to get a larger pullback once they start to break. In this particular case, right, if we look at it, you've got this swing point high back here that was broken, hasn't retested, so this would be the buy if this projects down. And that's one of the themes we're going to talk about a little bit later, is that even though we're slowly getting the rollover and the potential for something large, if it does break down, the general markets, they're going to be buys at lower price points. That's the XLP. Of course, the XLU doing the same thing, big breakdown on it. That goes to bearish as well, and you can see it doing it here on the weekly time frame as well. So that one's going to try to get into the the August of last year, the August lows, or at least the highs to start with. Those breakdowns are accompanied by other potential breakdowns that are starting to set up. Industrials, they're getting close to the same sort of setup on multiple time frames. The XLK, even though you would think this is strong, it's trying to break down. And another one, the XLV, with the biotech still being strong, XLV is still trying to break down. So you've got a lot of damage that's starting to take place on a technical level in this market. You've also got the collapsing debt instruments, the rising yields there, and the Hang Seng is also trying to test that lower range. On the fundamental side, you got the positives with the mergers and acquisitions may eclipse the record set in 2007, 2000 on a per month basis in terms of the amount of deals. But notice those dates. Those were highs in the markets, folks. Mergers and acquisitions usually come towards the ends of moves, not the beginnings. And so I put it as a positive in that this is what's helping to hold this market up. And another way you could look at it as a negative. On the fundamental side, negatives, the Greeks now have put all their eggs into a June 20th basket. So they've bundled all their payments. June 20th is 2 weeks away from Friday. So they're not even going to get the benefit of that next weekend. So really, you've got this coming week and the weekend to get the deal done, or at least to get it close enough to get it done. There won't be a weekend surprise, or if it is a weekend surprise, it will be another extension of that debt repayment. This is coming to a head. I think it's becoming more negative as a result of the way it's falling out. Still could be a positive, but I threw it in the negative one here. Employment numbers. These came out stronger than expected, quite a bit, 280,000. I don't put a lot of emphasis on each individual number, but the thing it's doing is it's allowing the Fed the cover that it needs to make that rate hike that it really wants to make. The Fed wants to make a statement. It continues to say that with its actions, and I'm talking about the guys that, are guys and gals that run the place, not everybody in there. And it looks to me like they want to make a statement. They want to make a rate rise. That's going to put pressure on the dollar to the upside. It's going to pressure other currencies to the downside. It's going to lift other markets potentially, unless the negative here at home is too great. It won't be that much longer. About a month, we'll be back into earnings season, or at least into the beginnings of it. And, a rising dollar again, if the dollar does spike again, is going to be a problem. Now, right now, it's not an issue, but if the Fed does this, then of course it could become an issue again. And I'm going to grab the dollar chart. I just want to show you that again. So the dollar had spiked up, right? Came back down, and now it's spiking back, or at least attempting to spike back up on the employment number. Still a big range market, so right now it's not an issue. It's only if this dollar really begins to take off again. As I've told you before, I suspect this dollar is going to trade inside this range. And as long as it does that, it's probably not a problem. At some point, though, it is probably going to do a continuation, head back higher. That's going to be a problem. But that looks like it's still a ways off. The ranges, what do I expect, or what I want to watch? I want to watch these ranges to start the week in Europe. Do they hold? Do they fold? That's going to be the key, because if they expand to the downside, right, then we're going to get more weakness here. The Friday selling, does that late Friday news that took place in Shanghai, is it going to create some short selling, not short selling, but is it going to create some selling pressure on those markets, and will they start to set up a range? If they fall, they're going to fall 5-10% easy, and they can do that in a day. So if we see huge drawdowns out of Shanghai, I think it will get people's attention. I think that's something also to watch to start the week. I think it's going to be a very slow week here. I mean, there's a few numbers, but there's not a lot. Industrial production is really the only big news coming out this week. So if we move to the bottom line, ask ourselves, what do we got here? It's really easy, and I want to kind of end this on a positive note, kind of backing into what I'd said before. And that is easy to see all the negatives. It's kind of human nature to gripe about this and that, but there's really a lot of positives if you think about it. And, dovetailing with what I said earlier, this market does look like it's going to try to trade lower at some point, somewhere over the next 2 to 3 months probably. If it does, and when it does, it's going to be a buy, not a sell. There's a lot of positives out here. I mean, the world growth, even though we keep griping about, the major countries, growth not there, If you factor in all the other countries where the growth is going, you're still in that 3 to 4% range that historically has been about the average for the world as a whole. So, you take countries in Africa, or take fringe countries, even in China, you take India. There is growth elsewhere. It's enough of it to keep the world growing. No, it's not gangbusters, but yes, it continues to be growth. Wages are starting to rise, right? If you look at the wages in the U.S., you're seeing more and more companies raise minimum wage without a federal mandate. Walmart just raised wages. McDonald's, I mean, all the lower tier companies, lower tier wage groups are getting raises. They're not huge, but if you get a dollar raise on a $10, $9, $10, you're getting a 10% raise. I mean, that's significant. I remember when I was a kid working and I got a quarter raise and it was like 2%. I thought it was great. So it's putting money back into people's pockets. We still have lower energy cost. At some point, that's going to lead to wage inflation, which is what the Federal Reserve really wants, and which will allow them to, increase the interest rates eventually, because you'll get wage inflations and the consumers will start to spend as a result. Now, I say that they would spend, but it really depends on their savings rates. Right now, savings rates are going up still. If that turns, right, you'll see consumer spending. Consumer spending is like 70% of a developed economy. You need consumer spending to, kind of prime the engine, so to speak. So that potentially could be a positive. The stimulus in China, Japan, Europe, it's all out there. U.S. isn't actually withdrawing stimulus. It's just keeping it going at the same rate. So that's a big positive to the world growth, market. Corporate profits, all-time highs. Their cash levels are at all-time highs. And these Chinese stocks, either that's the largest bubble I've seen in a while, or it's telling us something else is happening there in that transition that they're trying to do to a more consumer-oriented model maybe is going to take place, and something dramatic there is going to take place. So there's a lot of positives that we always kind of look over, and I guess I don't want to lose track of the fact that there are positives out there, and if this market does sell off, it's probably going to be a buy. And if I think about it just from on the negative side, right, this wall of worry, it's very high, and that's how markets climb. They climb these walls of worries that develop. And, I can't say, and I'm sure you feel the same way, it's like, man, there's so many problems, blah, 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 right? But this market has been able to withstand all that worry without giving up much so far. And if it finally gives it up, we need to be buying it. The real opportunity, there's really, it's in the markets. It's not elsewhere. I mean, if you get outside the financial markets, where are you going to go? Bonds pay nothing. Real estate's already been bought. If you were going to buy it, you had to buy it 4 or 5 years ago. Even if we look at the rental markets, and let me grab, I didn't want to do that. Let me switch here. I was going to grab the IYR, because this is a reflection of the real estate market. I mean, look at what's happening here, and we're talking the REITs for the most part. Down, right? Breaking down, broke down on Friday. And now these are what, why, actually it's a good point to make here. Why are these breaking down? Why are the utilities breaking down? Why do we see the consumer durables breaking down? Their nemesis, right? Their competition is what? It's interest rates. If interest rates are going to go up, these are going to go down, and that's putting pressure on these markets. This is back doing a retest regen on the real estate, but these markets are also mature. I mean, they've had their big runs, and the fact that they're starting to roll over is a reflection of that. Easy money in these markets just isn't there. There's not a lot of places to go and put your money outside financial assets. Okay, let's look at the portfolio. We're about a third invested again. We've been picking up stuff again as it falls. There's not a lot to talk about here. We just looked at the German markets, the CACs and the DAX. The euro. We could look at that one, and so let me grab that chart. So if we look at the euro, it's been on a nice little spike back up. Of course, this is in the context of a larger term move down, right? So what it's doing is it's doing what everything else is doing, and that is just building out a range. And that range right now, is from this area back up. It's gotten as high as there. Is it possible that it could make another range this high? Well, I guess it's possible. It's not likely. The more likely case is this range here. Let me redraw that. This range here at the bottom ends up being, doubled, right? And then you get another one on top of that, and that one actually takes you back up to the 117, 118 area. Why is that important? Well, because the 117, 18, 19 area, that's about where it broke down from. What is it? 118.46. And so, this could expand a range all the way up to that area. If it does, it's still the expectation that this thing is going to trade to the downside. And so when you're trading these range, you're picking your side and you're saying, okay, I expect the continuation of the general trend that's in effect, even though it's going to have these bounces along the way potentially. And so, yeah, there's the possibility this thing could bounce, but eventually you want to be short this thing, not long, and you want to be trading it in that direction. And that's what this EUO trade is, right? EUO is actually the opposite. It's a 2-to-1, so you can't stick around in it, but you're trading it expecting the ranges to continue. And right now, on the short term, we don't know that this thing is going to break higher, but we do know that it's still trading, and this is on the EUO, it's still trading in these ranges. And so as it gets towards the boundaries, you try to take your shot at it, expecting it to get back down in the bottom, potentially in the bottom, or to push back up into the other range. So, this is a short-term trade around those others. I think the more important trades are these two, not so much the EUO. This is one you average in and out of. HEDJ has been hurt as a result of, because these are hedged, and so they're as much a currency play as they are a directional play. They've been hurt as those markets have moved down. They're coming down in to test again, and again, if we look at these on larger ranges, there's the potential that these could expand their ranges and trade down again. And so if we draw these ranges in, we've got these, and if you put the other one on top of it, right, this could come back and come back into this retest regen zone. And as you know, when you get these breakouts, the first trip back, although this one had tested once, the first trip back on those indexes will be a buy, almost certainly a buy on the move back down. Also notice, your volumes were on the upside, not on the downside. So this all still looks positive to me. We just have to be prepared to buy again as it expands, right? As it teases here potentially, and as it expands if it does, and make the positions larger with the assumption, that these are going to trade higher over time, and I suspect that's going to be true. Buying retraces is hard for some folks. Buying breakouts usually seems easier. I prefer, actually, my chemical makeup prefers buy retraces, not breakouts. I don't know what yours is, but I like the risk-reward ratios better, when they're compressed. It's your best chance. If your timing is good and if your assumptions are right, it's your best chance to buy, not your worst. That's the HEDJ. HEWG looks about the same, right? It's down here and it looks like it's already broken, but we just looked at the German market itself and it hasn't. So again, what those ranges do over there is going to be important to what we do here. I still expect to add more if they break down. SBUC still testing the highs. Asher, as we were just talking about, a lot of that depends on what happens Monday or Sunday night tonight. in the Shanghai market, and XPI came back, and we picked up a little bit more. Now this is one of those cases, and I've talked about this before, and this is a good one to drive home again. And that is that, you know, when these things push to the tops of their ranges, you remember we sold it here as it pushed to the top of the range. Well, it turned out that it did push on higher. Well, what do? You just wait. You let it come back and you let it, you know, so you got the breakout. Now you want to buy the retest regen, which is doing what? Buying back in where you sold out. This is the way, you know, that, you know, you want the odds in your favor, right? In selling the top gives you the opportunity to potentially see this thing come back in and buy it at a cheaper price. Well, it didn't. It went higher. Well, that's okay. You just wait, right? And you buy it again at the cheaper price. In other words, you get back in where you got out, and you had two chances of winning, right? You had the chance of winning in that you can get back in where you got out, but you also had the better chance of winning is if this failed at this price point, right? You could have got it at a cheaper price point. And so you have, you know, you're putting the odds in your favor, and you're selling some on the expectation of a failure. If it doesn't fail, that's okay. We just wait, we buy it back at that same price point, and we're right back to where we were. We start all over again, right? It just cost us a little time. It's okay. It's the way the market works. It doesn't always do what you want or expect. And so this was a good example of, you know, you get a breakout, it's fine. You wait. You get the retrace. Now you get the bullish retest regen going. It looks like it's going to regenerate higher. So what do? You buy it back, and you get right back on board where you left off. I think that's about it to talk about today. So in general, you know, the markets, you know, I don't know if they're going to break down here. I honestly do not know that. And I don't know that anybody knows that. I know that they're under pressure, but you know, if you ask me what is my gut feel, my trading instinct, I expect this market is going to go back to the top of the range again. You know, so, you know, whether it's from here, whether it's from this level down here, you know, you come down and you test these areas and this is where it holds, I expect we're going to get some sort of a push back to the upside again, whether it's from here or from there. Is it going to break out and just run? I don't think so. I expect more that we're going to you know, probably be held in this range for another 2 or 3 months, and that on a longer term basis, right, we're actually going to see this thing roll over and test into these lows at some point. Now we may get this test before we know it. In other words, we could get it immediately over the next week or two, and potentially we're going to get this test as well. To get back here is going to be tough. It really is going to be tough. I mean, something dramatic is going to happen, or the fear level is really going to have to rise for some reason. You know, I suspect the odds on trade is somewhere in this range, and the best buys are going to be in this price point if we can get them. If it were to come down here, man, that would be a gem of a buy. And it's possible, but you know, right now it's unlikely. The more likely case is in here. But first, you just got to get some sort of a larger pullback, and we're right at a cusp where, you know, if we pull back a little bit farther, get some sort of a bounce, and then get a failed bounce, right? A failed bounce from that area, then would actually give us a much better opportunity. And what I'm talking about, just to draw it out, is that this thing comes on back. Let's say it gets back into this area, because that would be the ideal case. You get back down into here, and now you come back up, and somewhere in this big bar you fail, whether it's at the top here or whether it's at the bottom. And then that sets up, right, the larger ABCD structure potentially, right? If you came down to here, you come back up somewhere in here and fell, that sets up the larger structure to get you down to these areas that we're talking about. That to me is the most bearish case that could develop, and the one that we need to watch as we go forward here over the next couple of weeks. All right, I'm a little bit over on time. I'm going to drop it here. Thanks. If there's anything I can do to help, just give me a holler. Take care. Bye.